Hello guys, welcome to my YouTube channel. It is a continuation of previous case study. Last class I discussed about the bland kitchenware case study, and this is the second case study based on finance capital structure only. So in this case, actually this is based on the capital structure theory. Here you know which theory I have to apply. So what is the current perspective? So in this actually it is given कि a complex set of decisions created a firm capital structure. So capital structure dedicate the funding sources tapped by the company and what is the risk involved in that and how to control. What are the various perspective? Capital structure decision to enhance the value in financial market. What are the key decisions including the your overall mix of debt and equity? Because we know capital structure is nothing but it is a combination of debt as well as an equity in the form of term and maturity of capital structure of debt and the allocation of voting control among equity shares, the timing of security issuance and the host of issue, all this. So this approach is why I put this key. This, if you will read this case study, at least you will have a better idea in which what approach if I'm going to use, what are the assumptions is there in that. So classical theory, perfect capital market. So I should know that ki Modi Gilani and Miller were there. So the critical property of a perfect market are, what are the things? So in that critical market was there like no taxes, no transaction or uh, distressed cost was there. Then what are the common objective among the decision maker for value maximization of the company, how to calculate value of the firm, that is cost and debt and equity, perfect information available to all. So these things is given here, and how the modern traditional theory partial synthesis was there, how the modern traditional view built on theory but conclude the that a firm can pick an optimal mix of debt and equity by focusing on their trade-off mix of debt benefit. These things why it is very important, how the treatment of capital structure view in debt and equity generally, and what is the primary concern center on the overall amount of debt and less is said about the dimension of capital structure. So in this, what is the recent development in theory it's happened? That is very important. And more recent, what are the thought you have? Because if you have to explain the capital structure, you will get an idea ki how the in the capital structure, how we can involve the theory of capital structure, where we have to use different kind of theory, and what are the critical information that will be there for your for help. So these things is basically, that's why it is a full case study is there. This case study why I have previous the unit 1 I discussed about the agency cost. So agency cost of equity, one primary task of capital structure is the allocation of voting and control rights. Agency cost of using equity may raise if such uses created the wedge between the decision by manager and the interest of shareholders. So these thing is given, and this is a continuation of that. So agency cost of debt, how it will be help, and what how the asset substitution and incentive for over investment it will be there, how the shareholders will be benefited, how the distribution of dividend will happen. So equity share how it will get, and debt overhang and incentive for under investment how it will happen, because it is the second problem arises when the firm has excessive level of debt related to its asset but also has a profitable investment opportunity. So how he will manage, then what are the different profitable opportunity will be there, and how the other agency cost will be they have to find, and what is the connection with imperfect information. So this case study will give you the better idea about the full capital structure theory, pulling the element together, how you will get, and what is the trade-off theory is very important. Trade-off among five elements is there, ki how the tax benefit of financing, explicit cost of finance distress, agency cost of debt, agency cost of equity, singling effect of security issuance, all that will be where it is there, and what does this leave us. So this case study I checked and I make it for your friends, because at least you should know about ki how you have to purchasing power, how to understand about the customer, and this is the capital structure theory. Current perspective, because in this you have a full key factor to consider in the capital structure policy and how it will help. So what is the need and how you can approach the modern theory, Modigilani and Miller approach, and trade-off theory. So this theory is a very new theory, because previously generally we are using for capital structure NI approach and NOI approach, that is net income and net operating income. So Modigilani, how it will happen, how it is different from that. So all that is there. So please go through this and write in the comment box. And those who didn't subscribe till now, please subscribe my channel and like. Thank you so much for watching my video.